The broadcast is now starting. All attendees are in listen-only mode.
Good morning. This is Doug Voisard with Voisard Asset Management, and I'm glad that you've taken a little bit of time out here on this breezy fall morning, at least in Michigan. I know we have some out-of-state listeners to join us for the webinar. The program today will take about 30 minutes, and it's intended to bring you up to date on some of the changes in the cost basis reporting that begins on January 1 of this year coming up, 2011. So over the last 24 months, we've gotten a tremendous amount of new legislation, and that starts with healthcare reform, financial reform. We've got programs to boost the economy. We've got a ton of government spending going on, and so while it may seem like this is just an additional program, this was actually passed back in 2008. So it's not something new. It's something that the custodians have been preparing for quite some time. To begin with, just to give you an overview of the program itself, we're going to talk just briefly about cost basis and capital gains, talk a little bit about the current reporting requirements, what does it look like today, and then we'll move to the impact of the new legislation, the implementation schedule, and what is a covered securities. That's a new term that you'll start seeing a lot of, both covered and uncovered. And then look at the cost basis methodology. How are the custodians going to go about doing this, and what are we doing as a firm? Because certainly as the cost basis methodology changes, we're going to have to change as well. So with that and a cup of coffee in hand, we'll go ahead and get started with everything. First of all, just a couple of basic definitions, and we won't spend much time on these things. But when you're looking at cost basis, you're really looking at two key concepts. One is the original cost basis, and then the adjusted cost basis. You know, on the original cost basis, it's simply the price of a security plus the commissions of the broker or the firm that you use and any other fees. And those other fees might be like a securities and exchange commission fee or an exchange fee, or really those are the two primary ones. But you know, that's really what calculates your original cost basis. Then as time goes on, the original cost basis is adjusted because of wash sales, amortization or accretion, and corporate actions. And a corporate action might be like a stock split or a stock dividend or something that might change the number of shares or might change your cost basis. But adjusted cost basis is ultimately what you will end up using. So when we look at the adjusted cost basis, you know, when that asset is sold, adjusted cost basis is what determines the gain or loss. And again, this is probably review for most, but the capital gain or loss is really simply the adjusted cost basis minus the sales price. That's all it is. And that's really what you put onto your tax return in order to report and pay the relative taxes associated with that. Capital gains are divided into two different things, one of them being long-term gains, which are assets held longer than 12 months and taxed at a maximum rate right now of 15%. If, which we don't know, at the end of this year the Bush tax cuts expire, the capital gain rate will go to 20%. However, Congress hasn't really responded or acted on the expiration of those cuts, so we really don't know what capital gains is going to look like, but for right now it's 15%. Short-term gains, less than 12 months, and those, you know, are taxed at regular income tax rates, and those are taxed at regular income tax rates at the, you know, current level as well as at the after the Bush tax cut. So that's really not a change at all. When we look at what the current reporting requirements look like, there's really only a couple things that are required by a custodian, and that is that the gross proceeds on the sales of assets are reported to the IRS in after-tax accounts only. This does not apply to your retirement accounts because the money coming out of retirement accounts is just regular taxable income. So it's only in after-tax accounts that they're required to report those gross proceeds. The taxpayer then is responsible for putting them on Schedule D. And what we've done in the past is we've helped people, assisted them in the effort by tracking that information on our portfolio management system. So we would send out a capital gain loss report at the end of the year that you would put with the reporting that you get from Schwab. So those are really the only requirements. And what it kind of looks like, if I'm going to highlight a couple things here, you know, the gross proceeds, which are kind of outlined, and this is an actual 1099-B, which is how it's reported. What you'll see is you'll see the gross proceeds, and that's the only thing that Schwab really reports to the IRS. So the IRS doesn't have anything like, they really don't have anything in regards to what you paid for the security. And that's ultimately where the difference in the legislation stands right now, is that you know, that is going to change. The new legislation, which was created in 2008 under the Emergency Economic Stabilization Act, it was done a few years ago. Now what's going to happen is it's going to require the custodian to report the adjusted cost basis, including the gain or loss. And as time goes on, it'll just phase itself in. So it really phases in over a period of 3 years, over 2011, 12, and 13. It requires also that the custodian send the cost basis data on covered securities, which we'll talk about in a moment, on assets that are moved between custodians or transferred from one place to the other. And those are really, those are really ultimately the only two changes, is that they have to report the cost basis and they have to send cost basis on covered securities. Now, what's the implication here? Well, the Internal Revenue Service now, or going forward, will have accurate information on the purchase price, or the adjusted cost basis, and on the sales price of each security. And when you start looking at the IRS having both sides of the transactions, it's really a way to be more accurate in the reporting of cost basis and capital gain. Now, historically, people have not been very good at reporting reporting and tracking cost basis. I mean, if they bought a security 10 years ago, many times they have no idea what the cost basis is, so they guess or they estimate, and when they put that on their tax returns, there's no way for the IRS to know if that's correct or not correct unless they're audited. And so it's really an easy way for people to reduce their taxes if they want to. If they want to fudge the numbers, that's one place that they can certainly do it. Not that anybody does that, of course, but sometimes it's been known to happen. So when you get that accuracy, that improvement in accuracy, the accurate reporting means an accurate capital gain calculation because the IRS has both sides of the transaction. It means accurate taxation as well. And accurate taxation, of course, increases government revenue because everything is being reported. All the information that's necessary is being reported on your tax return and on the information sent to the government. So that's really where this comes into play. Now, of course, they didn't know that the amount of government spending that is occurring now, they really didn't know that that was going to occur back in 2008. So this is not a response to our current economic conditions. It's really something that's been a problem for a long time, and Congress just decided that it was time and appropriate to fix it. Now, over the next